Hi again, everyone. This is Bob with LoanModificationUSA.com, and I have for you right now part one of Hardship Loan Modification, Why Homeowner Hardship Doesn't Matter Anymore. Up until very recently, if you wanted to get a loan modification, you would have to have been experiencing a financial or personal hardship. You would have to explain in great detail why you weren't able to stay current on your mortgage payments. You'd have to write a personal hardship letter to your lender, exposing your most private details. Many times that letter would make or break the decision for your loan modification relief. Writing a hardship letter had the potential to cause a great deal of pain and stress for homeowners, as they had to relive every agonizing detail of their past just in order to save a few $100s a month on a loan payment. Well, I have some good news for you. There are about 60 million borrowers in the U.S. that no longer need to be experiencing a hardship to get a loan modification. That's right, the days of needing to experience a hardship to get a loan modification are over. It all starts with MERS, the lender's big mistake. In September and October of 2010, the mortgage industry was rocked by revelations of mistakes and even outright fraud committed in the handling of foreclosure documents. Upon learning of the widespread abuse of the foreclosure process, Bank of America and other major lenders, including Chase and Wells Fargo, voluntarily halted foreclosure proceedings in 23 states. It'll take a little time to sort out, and until it does, homeowners may get some reprieve as lenders slow down the pace of foreclosures. But this isn't the real news. The real story is the lender's use of MERS, or the Mortgage Electronic Registration System, to record the sale of mortgages in the secondary market. The impact of MERS is going to be widespread and will enable homeowners to receive mortgage principal reductions because of the mistake the lenders made in using MERS in the first place. Over 60 million loans were registered in MERS, meaning it's likely yours was one of them. What this means to you is that you no longer need to be experiencing a hardship to obtain a principal reduction. Because the lender's use of MERS has uncoupled the loan from the collateral, meaning your home, it's likely that your lender has no legal standing to foreclose on you. If you default, there's no owner of the loan that can bring foreclosure. Only the owner of a loan can foreclose, but because the loan was sold in pieces on the secondary market, your original lender isn't the owner. Nor is MERS the owner because they were only a nominee of the original lender. If your loan was registered in MERS, the lender can't foreclose, so they have no leverage on you. This means they'll be willing to negotiate a principal reduction, and you don't need to qualify for a HAMP loan modification. There it is. Hardship doesn't matter anymore. That's the end of part one of Hardship Loan Modification, Why Homeowner Hardship Doesn't Matter Anymore. To learn how you can get a MERS principal reduction, be sure to continue on to part two, where I'll further describe why homeowner hardship doesn't matter anymore and how you can get a MERS principal reduction. For now, thank you for your time with part one, and be sure to continue on to part two.